You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball, and my co-host John McEwen. In this week's episode, we'll be discussing Britvic, Associated British Foods, Homeserve, Imperial Brands, Brewin Dolphin, and Nvidia. So, should we start with Britvic, John?
Yeah. So, Sam, tell us what the results were.
So, Britvic have come out with their full year results. And for anyone who doesn't know Britvic, you'll probably know the brands. They basically do beverages. So, they've got, I'll just run through them. They've got Drench, Fruit Shoot, J2O. They've got the Pepsi license in the UK, Mountain Dew, Tango, Rockstar Energy Drinks, Robinson's Squash, 7-Up, Aqua Libra. Oh, they've got Gatorade as well. The list goes on and on. So they have come out with their full year results, and revenue increased by 6.6% to 1.405 billion. It's worth noting the statutory revenue was down 0.5%, but when you adjust it for constant currency and parts of the business that are now gone, it's up 6.6%. Profit after tax increased 9.1% to 103.2 million. They had record free cash flow generation of 132.7 million, which enabled a 31.9 million reduction in adjusted net debt. Full year dividend was up 12%, which reflected the board's confidence in their prospects and strong balance sheet. They had revenue growth in Great Britain and Brazil, which was led by a portfolio of family favourite brands. It highlighted continued growth in the at-home channels, with out-of-home rebounding in the second half. They've highlighted continued progress against their strategic objectives, including accessing new growth spaces with Plenish, Aqua Libra and Rockstar, and simplifying their Irish business with the closure of Counterpoint. They've highlighted strong cash generation with the adjusted net debt to EBITDA leverage ratio back to the 2019 levels. For the 2022 financial year outlook, they've said there's encouraging trading with volumes in the first six weeks of the year ahead of 2021 and 2020. They're confident in making further progress with revenue, profit and margin growth in 2022, despite inflationary cost pressures. Basic earnings per share was up 8.7% to 38.7p, and adjusted earnings per share was up 2.5% to 44.3p. If we split the results by segment, so they're primarily Great Britain. So of the revenue of 1.405 billion, 956 million of it comes from Great Britain, and that was up 8% year over year. 114.1 million comes from Brazil, and that was up 21% year over year. And 334.9 million comes from other international, which includes France and Spain, and that was down 1.3% year over year. However, I think other international is where the disposals are sat, so that's probably why that's down. They highlighted that they'd had total shareholder return since 2013 of 156%, which outperformed the FTSE 100 and the FTSE 250. And they've said in response to inflationary pressures, which we're seeing across the board week after week for anyone that makes anything, they are going to be implementing price increases across all their markets. I mentioned earlier that they repaid some of the debt. So the net debt now stands at 3 times operating profit, which I think is fine. In terms of the valuation, the business now trades at a price to earnings of 20.46 with a dividend yield of 2.72%. I think a PE of just over 20 is quite expensive, but for a business of this quality, with brands of this quality, I think you would expect to pay up for it. It's my view. What do you think of Britvic and these results, John?
I would tend to agree with you, especially on the valuation. But I suppose if you compare it with companies that are similar, like your Unilevers, maybe a little bit cheaper in terms of the price to earnings, but they're the sort of lower single digits, whereas this is getting to the higher single digits. So I don't think it's outrageously expensive at all. And again, really strong brands. I think it would be reasonable to buy at this price. It's a company that I like for the reasons that you've outlined.
Yeah, I like it. I think as well, the Brazil growth, what was it? Revenue growth of 21%. The volume growth in terms of litres was 14.9%. I mean, that's Brazil is 114 million of revenue out of 1.4 billion. So if that can continue growing at that rate, I mean, Brazil's a big market. And then they've got the other stuff like France and Spain. I probably wouldn't expect fireworks from France and Spain and the other countries, but I think with Brazil, if they can crack that, well, that PE soon comes down.
Yeah, and I would expect in the longer term that on-trade sales will improve as well, even with this new variant once we're past that. So I think, the long-term fundamentals are good too.
Yeah, and I do think the PE of 20, I think it's fair anyway, given the quality of the business. I wonder what, just a sec, I'll just have a look at AG Bar, because AG Bar is a direct, comparison. So that's also listed on the FTSE, and that makes Iron Brew. It's probably got a lower quality portfolio, I'd say.
Yeah.
So it'd be interesting to compare the two. Just one sec, I'll do it on normal. So obviously Britvic's just had full year results out, whereas the AG Bar PE showing based on the January 21 results. So that's not really a fair comparison. So I'll just do a normalized PE for it. So if we assume AG Bar's earnings are going to bounce straight back to the 2020 year, which ended 25 January 2020, I think that might be a generous assumption, because at that point, 7% of the revenue came from Rockstar, which has now gone over to Britvic. So this is probably quite a generous assumption, but if we use adjusted earnings for that year, they get a PE of just under 20. I know I would be picking Britvic every time if those PEs are the same.
Yeah, no, same. Absolutely.
Right. Should we move on to Associated British Foods?
Yes. So Associated British Foods is FTSE 100 company and best known for the Primark brand. They had their full year results this month, with full year revenues coming in at £13.9 billion, which is up 1% on the previous year if you exclude the effect of currency movements. Underlying operating profits were up 2% to £1 billion, with strong growth in sugar. And if we break the results down a little bit further, the retail business saw revenue fall 5% to £5.6 billion, and operating profits down 11% to £321 million, with the closure of Primark with the lockdowns and trading restrictions for much of the year. Interestingly, if you exclude the repayment of furlough, the group actually saw profits rise 15% to £415 million and expects to recover over £2 billion in sales over the next year. In the grocery side of the business, revenues came in at £3.6 billion, up 3% year on year, with strong performances from Twinings and the Ovaltine brands offsetting declines in Allied bakeries. Operating profits were down 2% to £413 million, with weaker margins and a £5 million restructuring charge in the Allied bakeries. In the sugar division, sales were up 8% to £1.7 billion, and operating profits were up a massive 75% to £152 million, with the increase in global sugar prices. In the agricultural division, sales rose 11% to £1.5 billion, and operating profits increased by 7% to £44 million. Meanwhile, ingredients sales rose 4% to £1.5 billion, with operating profits up 8% to £151 million. The group cautioned about the increased cost inflation in energy, logistics and commodities, but plans to increase the cost efficiencies and price rises across the food divisions to counter this. Free cash flow for the year stood at £862 million, compared with £1.2 billion last year, and net debt fell from £2.1 billion to £1.4 billion. In terms of valuation, Associated British Food currently trades at 13.2 times earnings, compared with a 10-year average of just over 20, and it currently yields around 2.5%. My impression, I thought these results were very good given the circumstances and the fact that Primark doesn't have online retail. So when it was shut, it was properly shut, and the increased prices of the soft commodities has lifted the other revenue streams and accounted for over 3/4 of this year's operating profits, but it shows the benefits of being diversified for this business. And it also has £1.9 billion of net cash on the balance sheet, which is very healthy, and it's announced a special dividend. So I think even given the global headwinds with the supply chain problems, it would seem cheap at 13 times earnings. What do you think of these results and Associated British Foods as a company, Sam?
I like it. I've always liked the business. I like the diversification because, like you say, it's not just Primark. They've got the sugar business, they've got the agriculture business, they've got the grocery business, and they've got some very good brands in there. They've got Patak's Kingsmill bread. They've got what's the sugar one called? I can't remember. My mind's gone blank, but the sugar one's really well known as well. But they've got some really well known brands. I like it. I mean, Primark's very good. When we looked at it last time, Primark was starting to open up in America as well. So I don't know how that's doing, but that's obviously, if they can crack that, that's pretty good. I'm assuming it's 13 times adjusted earnings, but I think the adjustments are probably fair because, for example, with the furlough, I think it's absolutely fair to take that out. And I wouldn't be worrying about like the 5% decline for Primark because they're not going to be repaying furlough every year. But yeah, I think it's pretty cheap because there's quite a few stocks where we've looked at them. And it's like you look at them and it's like, well, revenue might be down, say, like 30% compared to pre-pandemic levels, but the share price is as if the pandemic never happened. Whereas when you look at Associated British Foods, it's down significantly still. So it's £19 a share, and it's been as high. I mean, this is going back a few years, but it's been over £30 a share, and even a year ago, it was over £24 a share. I like it a lot. I think it's really good.
Yeah,
I really like.
Would you consider buying it at the current price?
I would actually, yeah. I mean, it's definitely good enough for the watch list. It's already on the watch list, but I mean, even if you look at the operating profits, what did they say? £1 billion of operating profit.
Yeah.
In 2019, the operating profit was 1.22 billion. So it's still got a good way to go just to get back to where it was. But I think the share price reflects that. And then you've still got, well, the sugar business, I know that's going to rise and fall because it's a commodity, but that's firing away in a minute. You've got Primark opening up in America. I think it's a really good business.
Yeah, no, I must say, and I was surprised at how cheap it was looking at it this time. Because we've seen it before, but I'm certainly more interested now.
It's not that far off the. Let's have a look at the low. The low's only like £17.50. And that's pretty much a 5-year low.
Yeah.
It's very close to the lowest it's been. It was actually a little bit lower in about 2020. But before that, you have to go back to, looks like about 2013 before it was lower. I think it's a very good business. And the dividend yield's not too bad either.
No, it's not. It's not. Okay.
No, I'll be having a look at that.
Okay, fine. So next company on the list.
What do we have next? We've got Homeserve, which, for full disclosure, I am a shareholder of. So Homeserve, most people have probably heard of Homeserve, but for anyone who hasn't, they basically do heating repairs, so like boiler repairs, that kind of thing. But most of the revenue actually comes from overseas rather than the UK, but you might know them in the UK. So they have come out with their half-year results, and they have announced revenue increased by 14% to 610.5 million. Statutory operating profit increased by 51% to 32.1 million. Statutory profit before tax increased by 86% to 18.9 million. Basic earnings per share increased by 93% to 3.9p a share. Adjusted earnings per share increased by 27% to 9p a share. Net debt increased by 7% to 625 million. And the Home Experts division is now profitable with adjusted operating profit of 3.7 million. However, I think most businesses can achieve an adjusted operating profit because you can just adjust out anything that anything you want to turn it into a profit. So it did still have a statutory operating loss of 1.3 million, but it is the first time they've been profitable on an adjusted operating basis. For anyone who doesn't know, the Home Experts division is, trying to think of how to describe it. I guess it's almost like a Just Eat, isn't it, for tradesmen? Is that probably the best way to describe? Is that you go on and like you search what you're looking for, and you get them, and then you look at the reviews and stuff. Yeah, so that's how I'd describe it. I don't know whether it's the best description. There you go. It's worth noting that it was up against relatively easy comparatives, but the revenue last year was actually a record year last year. But the problem was they had the extra costs. So yeah, the revenue was a record year last year, so they've beat that, and then on the cost side, the costs went up. So the operating profit and basic earnings per share, they were up against very easy comparatives, but the revenue increase of 14% is impressive, I think, because that was actually up against a tough comparative. So if we break it down a bit further, in terms of customer numbers in North America, they now have 4.8 million customers, and that's up 8% year over year. In the UK, they have 1.5 million, that's down 9% year over year. In France, they have 1.2 million, that's up 6% year over year. And in Spain, they have 800,000, and that's down 12% year over year. Overall, they have 8.3 million customers, and that's up 2% year over year. And in terms of the Home Experts side of the business, the number of paying trades on there decreased by 8% to 56,000. And the website visits decreased by 33% to 43.5 million. However, that includes Habitissimo, which is the Italian part of the business, and that changed its business model quite significantly, which we'll get to later. But if you look at Checkatrade, which is the UK version, number of trades increased by 8% to 44,000, and website visits increased 37% year over year to 18.2 million. And if you look at the revenue from the Home Experts side of the business, that was up 17% year over year to 80.5 million. And that included 56% revenue increase for Checkatrade. Let's go into the slides as well. So they talked about the North American business model, and they've said they're focusing on policy growth and customer satisfaction. Policies are up 12% to 8.5 million, and customer satisfaction has improved to 4.8 out of 5 stars. And then customer growth, as mentioned earlier, of 8% to 4.8 million. Net income per customer is up 7% to $111. In the UK, where they've had the decline, they've said the decline in customer numbers is starting to slow. So if you compare the customer numbers for the past 2 years, it went from 1.9 million in 2020 to 1.7 in 21 to 1.5 in 22. I've not looked at the exact numbers, but they're losing about 200,000 a year. I guess it's slowing because they can't lose as many now. But that is a small, the big driver of the business is the US side anyway. But yeah, if they can halt that decline, that would be quite nice. They talked about good progress in Japan, where they have a joint venture with another company, and they've got 3 utility partners signed, a strong pipeline. They've got access to 12 million households, which is almost 25% of the total. They've said the marketing campaign's performing well and retention is looking very strong. And for their Habitissimo revenue, that was down 3%, and that was because they transitioned to a directory extra model. And as a result of that, the adjusted operating loss reduced by 27% to 2.2 million. In terms of the valuation, on a statutory basis, they trade at a PE of 80. And on an adjusted basis, the PE is 20. However, they've adjusted it to remove the amortization of acquired intangibles, which I think is fine because they're not really real costs that you're going to see day to day in the business. So I actually think the adjusted PE of 20 is the right one to use in those circumstances. And it's also got a dividend yield of 2.89%. I own Homeserve. It's probably not my favorite holding, but I think PE of 20 is reasonable. I think the US is moving in the right direction. That's the main driver of the business. If the UK decline slows and the US carries on as it is, that will really start to reflect in the figures. And what I like about it is the Home Expert side of the business, where you've got this app where it is almost like a Just Eat or Uber kind of model. I've got a question mark over how profitable that can be. I genuinely don't know because it's not It's not been done before, really. It could be very profitable. It might be that it's not actually that profitable. But I think when the core business is at a PE of 20, that's what makes it very interesting for me.
Yeah.
John, what are your thoughts on these results and Homeserve as a business?
I think overall, going in the right direction. I'd be a little bit worried about what was happening in the UK and Spain and want to know why that was happening, why they're losing customers. I would wonder whether it's sort of down to the customer service just from on a personal level. I think my parents had less than good experiences when calling on Homeserve. And the impression was they were waiting on the phone for a long time and the service was overwhelmed at actually getting someone out. So I don't know whether they're a little bit stretched from that point of view in terms of staffing or whatever. But yeah, like you say, it's very international and diversified with good numbers coming from America. And if the app plays out, and even if it doesn't, it could still be very attractive. So yeah, I think it's one for my watch list. I don't own it. I haven't looked at it any further, but I probably will.
It's where one interesting thing is on that decline that you've talked about. They're in the last 2 years where they're losing 200,000 customers a year, their retention rate has not changed. It's been 78% each year. So the problem is, I don't think it's a churn. I think it's that they're not replacing the customers that are going out. That's the problem, because I don't know, 78% retention is. I mean, how high, for a business like that, how high is it going to be? You're not going to get it. It's certainly not going to be going above 90. It could probably be a bit higher than 78. But I think it's the acquisition of new customers that's the problem.
Okay.
Right. Shall we move on to Imperial Brands?
So Imperial Brands, the FTSE 100's second largest tobacco company, had their full year results out last week, with full year revenue up 1.4% to £7.6 billion at a constant currency basis. Tobacco volumes declined 2.9%, but price rises of 4.4% meant that tobacco revenue increased by 1.5%. Next generation products, including the Blue e-cigarette brand, reported a 3.9% drop in revenue, and the group exited several markets. If we break those results down a little further, Europe saw revenue come in broadly flat at £3.6 billion, with strong market performances in the UK and Germany, offset by reduced duty-free sales and a fall in market share in Germany. Underlying operating profits rose 5.6% to £1.7 billion. That's largely attributed to the reduced losses in the next generation products. In the Americas, revenues increased 9.6% to £2.5 billion, with strong cigarette pricing and a growing market share in the US. Underlying operating profit was up to £1 billion. And in Africa, Asia and Australasia, revenues fell 8.2%, excluding the recently sold premium cigar division, and underlying operating profit was down 4.7% to £598 million, with changes in the Australia excise regime costing the group a further £88 million. The distribution division saw revenue rise 5.8% to £1.1 billion, with strong growth in Spain and Italy, leading operating profits to swell 11.3% to £265 million, and organic operating profits were up 4.8% to £3.6 billion, with the losses in the next generation products cut by 57%. Free cash flow came in at £1.5 billion, and net debt fell 16% to £9.4 billion. And the group commented, at constant exchange rate, we expect to deliver net revenue growth at a similar rate to 2021, while adjusted operating profit is expected to grow slightly slower than net revenue, reflecting the step up in investment in line with our 5-year strategic plan, and after taking into account the non-repeat of the US state litigation settlement costs. In terms of valuation, Imperial Brands trades at just 6.4 times forward earnings, compared with the 10-year average of just over 10 times forward earnings. And at the moment, it's yielding an impressive 9%. So these results seemed strong and largely in line with what the market was expecting for an industry in structural decline, still managing to increase revenue and profits despite volume decline. And it managed also to reduce debt to just 2.2 times underlying cash profits, so within the strategic aims of the group. And while the group took on a lot of debt to buy the blue e-cigarette brand from Reynolds for $7.1 billion back in 2014, and the fact that it hasn't been performing well in a number of markets, it's now exiting some of those. And in Europe, it's actually grown revenue 8.6% in the last year. I suppose it's a company that inevitably is hit by the sort of prevailing views in ESG investing and the ethics of the business. On paper, at least, it looks very cheap, and it does reward investors with a large dividend, which obviously can never be fully guaranteed, but it looks fairly well covered at the moment. Sam, what are your thoughts on Imperial Brands and these results?
Do we know what the actual revenue figure is for the next generation products?
So the next generation products net revenue, excluding investment, is £188 million for 2021.
What was it? Like under 200 million out of 7.6 billion. It's still tiny. So really, it is still all about the cigarettes. I don't know, because I think I know they can't continue. We say it every single time, and they continue to do it. But although they can't continue to just increase prices forever, even if they've got to a point where they couldn't increase prices further, it's hard to say when that point is, when people are literally addicted to the products. But with volumes falling 2.9% during the year, even if prices weren't increasing, if you were having a 2.9% drop in volumes every year, and you were assuming that fell through exactly to revenues, it's still cheap at a forward PE of 6. So if you work the numbers through, it takes a lot more than the 6.4 years before the business goes. So if you're getting it in a PE that's that low, it's going to be a number of years, even if they can't increase prices before those earnings significantly start to drop. So yeah, I think it's very cheap. And it's got a nice dividend as well.
It's huge dividend. And
it's that's after they've cut it as well. It's pretty secure now, isn't it?
Yeah, exactly. So it's a company that on paper at least looks very cheap. And I suppose its sentiment towards it has been negative for a number of years. So I think that probably contributes to the share price decline and why people aren't buying it. But institutions moving out.
I just think if the share price was to stay flat the whole time you owned it, I think you're probably going to beat the FTSE just on the dividend.
The dividend.
You don't need the share price to grow, because what's the yield? Like 8 or 9%?
It's not 9%.
9%. I mean, including dividends, you do pretty well to get 9% a year out of the FTSE.
Yeah.
No, I like it. I think there's obviously some people might have ethical concerns, but I think if you're looking at it purely as a stock, I think it's very attractive.
Yeah. Fine. Okay. Next company, Sam.
We have Brewin Dolphin. So for anyone who's not familiar with Brewin Dolphin, they're basically a wealth manager. That's the easiest way to think of them. So they have come out with their full year results, and they've announced strong total discretionary net flows of 1.9 billion, and that's up from 0.9 billion last year, which represents an annualized growth rate of 4.6%. That included record discretionary gross inflows of 4 billion, up from 2.8 billion last year, which benefited from strong brand advocacy as well as a broad range of propositions and investment solutions. Discretionary net flows of 0.5 billion from direct clients and 1.4 billion from indirect clients, of which 1 billion flowed into MPS and Voyager, which are two of the products, with Voyager being a new product this year. Total funds increased by 19.5% over the last 12 months to 56.9 billion, and that's up from 47.6 billion last year. Total discretionary funds increased 20.9% to 49.8 billion, and that's up from 41.2 billion last year. driven by positive net flows and strong investment performance. Total income for the period increased by 12.3% to 405.9 million, and that's up from 361.4 million last year. And that was again driven by strong market performance and record discretionary gross inflows. Financial planning income grew 25.7% to 41.6 million, and that's up from 33.1 million last year. And that was driven by both 1762 from Brewin Dolphin and the Wealth Core propositions. Adjusted profit before tax was up 16.2% to 90.9 million, with margin of 22.4%, and that's up from 21.6% last year. That was driven by strong income growth and cost savings of 2.6 million associated with COVID-19 restrictions. Final dividend per share was up 12.1% to 11.1p, taking the total to 15.7p per share, compared to a total of 14.3p last year. Basic earnings per share was up 15.3% to 18.8p, and diluted earnings per share was up 15.5% to 23.8p. In terms of the split of the income, the direct discretionary was up 13.8% for the fees to 181.9 million, and indirect discretionary was up 12.9% for fees to 87.7 million. So total discretionary income was 269.6 million. So it's 269 million in total. Of that discretionary income, as well as the fees, they get another 70 million from it from commissions. They've then got financial planning income of 41 million, execution only fee income of 4.8 million, execution only commission income of 7.1 million, advisory investment management fee income of 4.4 million, advisory investment management commission income of 2.7 million, investment BPS investment management fee income of 1.6 million, and expert witness report services of 1.7 million. So the bulk of that 404 million is discretionary investment management fee income of 269 million, discretionary investment management commission income of 70 million, and then the financial planning income of 41 million. So the financial planning income actually makes up about just over 10% of revenue now. How much was that up? And that's growing at 25.7% a year. In the slides, there were a few interesting points. Yes, the fund growth was driven by 5% discretionary net inflows and strong market performance, they said. So if you look at the total funds, that was up 6% in 2019 to 2020, and then it's up 20% this year, with discretionary funds up 3% 19 to 20, and then 21% this year. They've highlighted that operating costs for the 2022 financial year are growing in the mid to high single digits, and they put that down to wage inflation. Oh, one of the things they mentioned was wage inflation and the increase in national insurance rates. They highlighted that they've got approximately 4,000 new clients, which is up 25% year over year, and 70% of the inflows are from new clients rather than new funds from existing clients. It talks about, well, they said the Ireland acquisition supporting performance momentum. And the Ireland discretionary funds was up 36% to 3.4 billion. And that represents 10% of the group's total funds. In terms of the valuation, it's trading at a PE ratio of 14.13, and the dividend yield is 4.59%. My view is I like it. I think it's a well-run business. I think they're they seem like a high quality outfit. My biggest concern with it would be that it's probably quite cyclical, in that a lot of their growth in funds is because of the way the stock market's going. And when you start to see that the reverse, that PE of 14, although it looks quite reasonable, if the stock market was to get cut in half, so do their funds. It's probably reasonable to assume. So that PE of 14 then becomes a PE of 28. You're then getting into, well, what's going to cause markets to go down in the current environment, or not what's going to cause it to come down, but I guess in the current environment, where else have you got to put your money? So you've got that in their favor. But my biggest concern with it is that it probably is a cyclical business. So although it seems quite reasonable at a PE of 14, we're probably closer to the top of this market than the bottom, I'd say. What are your thoughts on these results and Brewin as a business?
I guess I'd echo your thoughts. The other thing I would concern me about is there's so much competition in the market, and fees are being driven ever lower. There's a lot of passive investment and, growth in platforms like Vanguard, which have their direct consumer sort of division. I would be worried about that. That would probably be, apart from the business being cyclical, that would probably be an overriding worry, and probably a reason that I wouldn't invest. But it does, like you say, look like a well-run business, and when the market's doing well, Brewin's doing well.
The thing is, those concerns, they don't really show up in the numbers. It does look like a business that's firing. You're not looking at it and saying, "Oh, well, look at those customers leaking out." They're obviously they're going to Hargreaves or wherever else. That's just not showing up.
No.
But
I know.
Well, we saw the AJ Bell had the new one out today, didn't they? Their new product, or is it today? Whatever it was.
I think it's certainly been recently. It's called like Diddle or Doodle or something. Doddle. Yeah, Doddle. Those sorts of things. And I suppose I'd worry maybe in the longer term that younger investors who are starting out now would be reluctant to pay the fees in the longer term with companies like Brewin. Whereas I suppose at the moment they've got slightly older generations who generally have more capital, who are going to be invested in their funds. So I would wonder that it's maybe a longer term trend.
I think there's always going to be a big proportion of people that, although they could do better themselves, they're not really aware of it, so they just want to leave it to the experts.
Yeah.
I guess the flip side would be you'd say, well, you don't really have that issue with Vanguard.
Yeah.
Whereas I think the people that are going on free trade and stuff, if they're going, if you get someone at 20 where they go and put like $5,000 into free trade, lose it on Tesla, they might come back at 40 or 50 when they've got some money and say, well, actually, no, I want Brewin looking after this because I don't know what I'm doing. So I can't really attack it. That's the reason I probably wouldn't invest. But it's not to say it's not a decent business. And it's difficult because it just doesn't. I agree with your concerns because there is serious competition. There's certainly a lot more competition now than there was 20 years ago. I don't think there's really any doubt about that. But it just doesn't. It's not showing up in the numbers. I mean, I guess you could say, well, the numbers would probably be a lot better if Hargreaves Lansdown and Co didn't exist. But these are really good numbers. Yeah. Whether or not it's a case of a rising tide lifts all boats, we'll have to see.
Yeah.
The biggest concern for me is actually the cyclicality of it.
Which is another issue with this type of business. But okay.
Right. Shall we move on to our US company of the week?
Yes. So our US company of the week is Nvidia, the American artificial intelligence company, traditionally known, well, probably most well known for its graphics cards. They had their third quarter results out this week, with revenue from the quarter up 50% year on year at $7.1 billion, with strong growth in data centers and professional visualization. The operating profits were up 91% to $2.7 billion. And if we look at the results in a little bit more detail, the gaming revenues rose 42% year on year to $3.2 billion, with increasing demand going into the Christmas period. Data center revenue was up 55% to $2.9 billion, with increased sales in cloud computing and natural language processing customers. In the professional visualization division, sales were up 144% to $577 million, with increased sales in laptops and workstations, with many employers adopting hybrid working. And their automotive division, which is much smaller, saw sales rise 8% to $135 million, with their self-driving and autonomous vehicle technology. OEM and other sales rose 21%, and that was in part driven to the demand for crypto mining hardware, so primarily the graphics cards. In terms of valuation, Nvidia has a market cap of $807 billion, and it trades at a forward price to earnings of 64, with a 10-year average of 30, and its prospective dividend yield is negligible, 0.1%. It's largely been doing share buybacks. But yeah, I mean, they're pretty incredible results. You would argue that they're reflected in the valuation. but particularly the growth in the data centers and the cloud computing, which has such high margins, is attractive. And they're currently, well, there's an ARM acquisition pending, which seems, if it goes through, like a very astute purchase, given that most Android phones, all iPhones, and all new Macs are going to be operating on the ARM platform. And it's the potential for its use in the artificial intelligence software going forward. It seems like an extremely high quality business in a growth industry, but it is, very expensive. Sam, what are your thoughts on Nvidia as a company and these third quarter results?
Similar to you, it's fantastic numbers. It's a really good business, but for a business of that size, I just would not be willing to pay 64 times next year's earnings. I just don't. I don't see how it grows into that valuation. I think all the growth's already priced in, really.
Fair enough.
But it's doubled in the last year, and it's about 11 months since we did the fantasy portfolio, and off air, you wanted it in, and I talked you out of it. So that would have, I mean, had that gone in, which I wish it had now, but had that gone in, I would be making a strong argument when we update it in a few weeks' time to be selling that and putting it in something else. I wouldn't be comfortable holding that.
No, but I mean, it was one of those things that we talked about it off air. It's much easier to take those risks when it's a fantasy portfolio or when it's not your own money. No, we still didn't want to do it, but when it is your own money, I mean, I don't know how you psychologically purchasing something that expensive with those sorts of risks, I wouldn't do. But yeah, like for the fantasy portfolio, even then we weren't confident enough to do it, but it's easier and in this sort of market. But for reference, over the last 10 years, it's been an 81 bagger.
That's all right.
Incredible growth. And it's the market cap. It's ginormous. It's nearly $1 trillion. Well, it's not far off $1 trillion.
No, I mean, when you look at the 10-year graph, it's exponential.
Yeah.
It only needs to go up another third. I mean, if it's doubled in a year and it only needs another third to get to $1 trillion, it's probably going to hit it.
It's incredible numbers, but it's an exciting business anyway to watch going forward, and it'll have some British technology in it. Which I mean that's part of it. Well, some of the difficulty it's having, I suppose, at the moment with the acquisition is controversial, but interesting nonetheless. So, of the companies that we've covered this week, Sam, what would be your pick or your pick of the week?
Despite the fact that I own Homeserve, which I did quite like, I also actually there's a few good ones this week. I'd say actually I thought they were all pretty good except for Nvidia. Nvidia is just a valuation, but I'd be quite happy.
The valuation, not the results.
Yeah. But I'd be quite happy holding any of the other five probably. But for me, it was probably Associated British Foods. What about you?
Yeah, it's boring, but yeah, Associated. And I genuinely go out and look at it even more, and I may well buy shares in it.
Yeah, no, I'll be taking a look at it as well. I think it's a very good business. I've always liked it. I've quite liked the diversification. Yeah. It's kind of like a baby Berkshire, isn't it?
I mean. Well, I don't know about that, but it's looking at it this week, because we had looked at it before, but particularly with the valuation, I thought, that looks half decent.
Yeah, right.
Okay.
I think that's everything then.
What's the next episode? You're doing an interview, is it?
We've got 20s Trader Part 2. But that's going to be more similar, actually, for anyone who's listened. If you've not listened to Part 1 yet, I would recommend going and doing it. But it's going to be more closer to what we do every week than the normal interview, because what happened was we did the interview and we ran out of time, so all the stock stuff we're just putting in one episode, so it's almost like a hybrid between the interviews and these normal episodes. But yeah, I thought it was very good when I edited it, but I'm slightly biased.
Exciting stuff.
All right, well, we'll see you next week.
No, exciting stuff. Look forward to it. See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIW Tweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.